Hi friends, welcome back. I am CA PRITISH Burton and today's topic is very interesting one. In case if you are planning to sell your property and want to pay no tax or zero tax at all, then this is the video which you have to watch till the end. We are talking about capital gain tax in case of sale of house property. So first, in order to understand the capital gains tax, we need to understand what is taxed under capital gains. Capital asset, in case if there is a gain, when you sell a capital asset, then it will be taxed under capital gains. So first we need to understand what is a capital asset. Any significant property that an individual owns. It could be a residential property, it could be a commercial property, it could be even gold, shares, bonds, or any piece of art, drawings, anything that you sell, it is taxed under capital gains. So if there is a profit, if there is a difference that is which is higher when you sell from the purchase cost, the difference will be taxed under capital gains. But there are certain exceptions, and that includes personal effects, including wearing apparel and even a motor vehicle in case if you have used it for your personal purpose. And more importantly, a property which is agricultural property, which is outside the municipal limits, is not classified under capital asset. So in case if you sell an agricultural property, then it is not a capital asset and it is not taxed under capital gains. So it should be a rural agricultural property. So now why capital gains? So in case if you think that it is okay not to show in your income tax returns if you have made any gains while selling your property, then it is a big mistake. Because let me give you a simple example. When you register the property, your PAN card is updated in the sub-registrar office. So it automatically gets picked up and you will be in serious trouble while getting an income tax notice. So do not get into that kind of a trouble and file your returns regularly, and more importantly, include any capital gains if you have in the previous financial year. In this video, we are going to focus only on capital gains tax on sale of residential housing property. So first, let us understand the difference between a short-term capital asset and a long-term capital asset. In case of short-term capital asset, if you sell the housing property within a period of 24 months, it is classified as short-term. Whereas in case if you sell the housing property after 24 months, it is classified as a long-term capital asset. Why this differentiation is important is for the simple reason that short-term capital asset or short-term capital gain is taxed at the rate that is applicable in case of your other income as well. In case if you fall under the 20% bracket, short-term capital gain is also taxed under the 20% bracket itself. Whereas in case of long-term capital gains, there is a different tax rate that is applicable. That is 20% plus cess, that is 20.8% will be the tax rate that is applicable in case of long-term capital asset. So now a very interesting point about short-term capital gains is that you cannot save taxes in case of short-term capital gains, but you will have to pay them. But in case of long-term capital gains, you need not pay any tax because there are benefits that are given by the income tax department and you can save taxes legally and pay zero tax. Let me tell you how. The first benefit that you can avail is the benefit of indexation. Everyday prices keep rising and that is how your money will not have any value in case if it is not adjusted for inflation. So similarly, in case of our capital gains as well, your purchase price or purchase cost is adjusted for inflation. So let us consider that you had purchased a property in the year 2001-2. So even in case of income tax department, the same year is considered as the base year. So now you sell the property in the year 2001-2 for say for rupees 5 lakhs. So in that case, your purchase cost is not rupees 1 lakh but is adjusted for inflation. So how much is the cost of inflation index for 21-22 is 317. So in the year 2001-2, it is the base year, it was rupees 100. It remains rupees 100 itself because it is the base year. So it is simple math, 1 lakh rupees into 317 divided by 100. So this is how the calculation is done. Very simple calculation. So anybody can do it. So your purchase cost now is rupees 3,17,000 rupees. So this cost of inflation index is different for different years. You can Google and check the cost of inflation index. In case if you had bought the property in the year 2005-6, the cost of inflation index is 117. So it is different for different years. So you can do your calculation yourself. Another benefit that you can avail is the indexed cost of improvements. So that is, in case if you have done any improvements to your property, residential housing property, then you can avail the benefit of indexation even in case of improvements. Say, for example, you had spent around 50,000 in the year 2005-6. Similar calculation using 117 as the cost of inflation index and 317. That is 50,000 into 317 divided by 117 is your cost of improvements, indexed cost of improvements in the current year. So your capital gains basically works out like this. In case if you sell the property for rupees 10 lakhs minus indexed cost of purchase and indexed cost of improvements, and if there are any other selling expenses, that also you can deduct. So the balance will be your capital gains, which can be saved entirely based on our sections, that is section 54 and 54 EC, which we are going to discuss now. So now we are going to talk about section 54, which is going to help you save the entire long-term capital gains. So the first thing that you need to do is you can either buy the property, another house property, within a period of 1 year before the date of sale, or 2 years after the date of sale, you need to buy another house property. Otherwise, you can even construct a residential house property within 3 years from the date of sale. Then you did not pay any tax at all. So now, another important point that you need to see is that you can invest not only in one property, a maximum of 2 house properties. Earlier, it was only one house property. Now you have the option of investing in 2 house properties. Another important thing, that the house property should be only in India itself. So this benefit is available only in case if your capital gain does not exceed rupees 2 crore, and this is available only once in your lifetime. Another important thing that you need to focus is that in case if you sell the house property, the new house property within a period of 3 years, then it will be taxed or it will be reversed. Whatever benefit you had got earlier will be reversed, and the capital gain that you get will be taxed as short-term capital gains. Now, how much should you invest in the new house property is the question. The answer to this is that in case if you have sold the property, say for rupees 40 lakhs, the purchase cost is rupees 20 lakhs. So the capital gain is 20 lakhs. So in case if you invest the entire amount of 20 lakhs in the new house property, then there is no tax at all. So in case, say for example, you invest only rupees 15 lakhs, the balance amount of rupees 5 lakhs will be taxed under capital gains. Now, in case if you are not able to invest in the new house property within the stipulated period of 2 years or 3 years, what you can do is you can park the funds in an account, a separate account called capital gains account scheme, which is available in all the major banks. And when you can invest in the new house property, you can use the same amounts to invest in the house property. But provided that you have to park these funds or deposit these funds in that separate account before filing your income tax returns. So there are many people saying that we do not want to invest in a new house property. We are satisfied with what we have. So in that case, you have another option, which is section 54 EC. So friends, before going to section 54 EC, in case if you have not subscribed this channel, please subscribe, like, comment and share so that it will help me motivate to make more videos on these important subjects so that you can plan your taxes in time. So yes, about section 54 EC. So the most important thing about section 54 EC is that you do not invest in a new house property, but instead of that, you invest in specified bonds like Rural Electrification Corporation bonds, Power Grid Corporation bonds, NHAI bonds, Railway Finance Corporation bonds, and the lock-in period here is 5 years. You have to stay invested for 5 years. The interest rate approximately is around 5 to 5.25%, which is taxed. But at the time of maturity, there is no tax at all. It is completely tax-free. There is a lock-in period of 5 years. Keep that in mind. And the maximum amount of investment is rupees 50 lakhs. But you have to invest in these specified bonds within a period of 6 months from the date of sale of your property. And another important point is that you can invest in these bonds either online or these are available in any of the major banks. So friends, another frequently asked question is that in case if we gift our property to any of our relative, whether it is taxed, Any gift that is given by a relative is tax-free provided the definition of relative is met. So here are the relatives as per the Income Tax Act. So friends, this topic is only about how to save taxes in case of sale of residential house property. But in case if you want videos on other topics like how to save taxes on commercial house property and other capital assets, please feel free to comment below. I'll be making separate videos on those topics as well. And in case if you have any doubts on this topic, because you can have many doubts on this topic because the nature of topic itself is like that, then please feel free to comment below. I'll be answering one by one. So thanks for watching and stay tuned for many more videos on investments, finance and taxation. Happy investing.